In early 2025, Sarah and Tom felt the squeeze. Their initial mortgage, taken years ago, now felt heavy. Interest rates had shifted, and their monthly payments were a constant worry. They dreamed of a lighter financial load. Daily headlines screamed about economic changes and inflation. Friends at gatherings often discussed rising costs. Sarah and Tom knew they couldn't ignore their mortgage situation any longer. A change was urgently needed. One evening, while researching online, Sarah stumbled upon articles about mortgage refinancing. It promised potential savings and lower payments. A spark of hope ignited, but also many questions. Tom joined her, intrigued. Refinancing sounded like a complex financial puzzle. They needed to understand if it was the right path for their family and if it would truly offer significant relief. Their current mortgage was a fixed rate, chosen for its stability. But with current rates lower than when they originally purchased, they wondered if they had missed an opportunity for improvement. The concept of fixed versus adjustable rates kept appearing. They realized this was the core decision point. What did each option truly mean for their long-term financial health and peace of mind? Their initial research led to more confusion than clarity. Financial jargon filled every article, making the process seem daunting. They felt overwhelmed, yet determined to find answers. Sarah suggested they approach a financial expert. Someone who could cut through the noise and explain the options in plain English. Tom agreed, professional guidance was essential. They booked an appointment with a local financial advisor, Mrs. Davis, known for her clarity and practical advice. This felt like a significant step forward in their journey. Before the meeting, they listed all their questions. What are the true costs of refinancing? How much can we actually save? What are the risks of an ARM? Their future depended on these answers. The day of the appointment arrived. Sarah and Tom walked into Mrs. Davis's office, feeling a mix of nervousness and anticipation. This was their chance to gain real clarity. Mrs. Davis greeted them warmly. She began by explaining the basics of a fixed-rate mortgage. It's simple, she said, your interest rate and monthly payment remain constant for the entire loan term. Sarah immediately understood the appeal of stability. So, no surprises, she asked. Mrs. Davis nodded, exactly. It offers budget predictability, which is valuable for many families. Tom considered this. Their current mortgage was fixed, and they appreciated not worrying about fluctuating payments. This stability had provided a sense of security during uncertain times. The main drawback, Mrs. Davis continued, is that if market rates drop significantly, you won't benefit unless you refinance again. You're locked in. They discussed the long-term view. For homeowners planning to stay in their house for many years, a fixed rate often provided the most peace of mind and predictable financial planning. Next, Mrs. Davis moved to adjustable rate mortgages, ARMs. These start with a lower interest rate for an initial period, typically 5, 7, or 10 years, she explained. Tom's eyes lit up at lower interest rate. So, we pay less initially? He asked. Potentially much less, Mrs. Davis confirmed, which can free up cash flow in the short term. However, she cautioned, after that initial period, the interest rate adjusts periodically based on market indices. It can go up, or it can go down. Sarah immediately thought of the risk. What if rates go way up? Mrs. Davis explained that most ARMs have caps, limiting how much the rate can change per adjustment and over the loan's life. She showed them a diagram illustrating how an ARM rate might fluctuate over time, moving up and down. It looked like a roller coaster compared to the fixed-rate steady line. An ARM might be suitable, Mrs. Davis advised, if you plan to sell your home before the adjustment period ends, or if you expect your income to significantly increase. Tom and Sarah pondered this. They loved their home and imagined living there for decades. Selling soon wasn't in their plans, making an ARM seem less appealing. The advisor emphasized that an ARM requires a higher tolerance for risk and a willingness to monitor market conditions. It's not a set-it-and-forget-it option. So, the savings of an ARM are only certain for the initial period? Sarah clarified. Mrs. Davis affirmed, precisely. Beyond that, it's a gamble, albeit a calculated one. They felt a weight lift, understanding the fundamental difference. The initial appeal of lower ARM payments now came with a clearer understanding of its potential long-term costs. Mrs. Davis then moved to the broader context. What rate actually saves you depends entirely on your personal circumstances, your risk tolerance, and your outlook for future rates. She encouraged them to think about their financial goals. Were they prioritizing short-term cash flow or long-term payment stability and predictability? This was a crucial self-assessment. Sarah and Tom spent time discussing their answers. Tom, an engineer, valued predictability. Sarah, a teacher, valued peace of mind and avoiding future financial stress. Consider the broader economic landscape of 2025, Mrs. Davis advised. Are experts predicting rates to rise, fall, or remain stable in the coming years? She presented them with various economic forecasts. Some predicted continued rate stability, others a slight increase, but none suggested a dramatic downturn in rates. If rates are expected to rise, an ARM becomes riskier, she pointed out. Your initial savings could quickly be eroded by higher payments after the adjustment. Conversely, if rates were expected to fall significantly, an ARM might allow them to benefit from those lower rates without a further refinance. But 2025 forecasts didn't strongly support this. Tom considered their career paths. Both were stable, but a huge jump in income wasn't anticipated. Relying on future income to absorb higher ARM payments felt precarious. Sarah thought about their children's future education costs. Any unexpected surge in mortgage payments could jeopardize their ability to save for college funds. What about closing costs? Tom asked, remembering something he read. Do we pay those again for refinancing? Mrs. Davis confirmed yes, they do, regardless of the chosen loan type. She explained that these fees could range from 2 to 5% of the loan amount, and they needed to be factored into the overall savings calculation. Sometimes, paying them upfront made sense. Alternatively, they could be rolled into the new loan, which meant paying interest on them over the loan's life. This would increase the total principal. Mrs. Davis presented a detailed comparison sheet, showing projected payments for a fixed-rate refinance versus an ARM refinance over 30 years, including closing costs. The numbers spoke volumes. The ARM offered lower initial payments, but under various rate increase scenarios, it quickly surpassed the fixed-rate option in total cost over the long haul. They saw how saving wasn't just about the lowest monthly payment. It was about the total money spent over the lifetime of the loan, coupled with their peace of mind. Consider your break-even point, Mrs. Davis advised. This is how long it takes for your monthly savings to offset the closing costs of the refinance. If they plan to move before reaching that break-even point, refinancing might not be financially beneficial. But they hope to stay put for decades. The advisor emphasized the value of financial peace of mind. Knowing exactly what your mortgage payment will be each month is often worth more than chasing the lowest initial rate. Sarah and Tom had a clear choice forming. The appeal of the initial lower ARM payments was dimming against the certainty and stability of a fixed rate. They thanked Mrs. Davis, feeling enlightened and confident. The complex puzzle of refinancing had finally become clear. They now knew what questions to ask themselves. Walking out of the office, the 2025 financial landscape didn't seem as daunting. They had a strategy, tailored to their family's unique situation and goals. Over dinner, they talked it through one last time. Tom created a simple pros and cons list on a napkin, sketching out their priorities clearly. Stability and predictability were paramount. The slight risk of missing out on lower future rates was outweighed by the assurance of knowing their payments wouldn't suddenly surge. Their decision coalesced: a fixed-rate refinance. It offered the long-term security they valued, aligning with their desire to stay in their home and plan for their children's future. The next day, they began contacting lenders. Armed with their new understanding, they could confidently ask pointed questions about rates, fees, and terms. They compared offers from several banks and credit unions. It was crucial to look beyond the advertised lowest rate and examine the full disclosure of each loan. One lender offered a slightly higher rate but significantly lower closing costs, making it a better deal overall when considering their break-even point. They completed the application process, gathering all necessary documents, income verification, property details, and existing mortgage statements. The paperwork was extensive, but knowing they were making an informed decision made the effort feel worthwhile. Every signature brought them closer to their goal. Weeks passed as their application was processed. The anticipation was palpable. They frequently checked their email for updates, eager for the next step. Finally, the approval came through. Their fixed-rate refinance was approved at a significantly lower interest rate than their previous mortgage. They scheduled the closing. The day arrived with sunshine, mirroring their brightened outlook. This new chapter for their finances was beginning. At the closing table, the final documents were signed. Their new, lower fixed monthly payment was official. A sigh of relief swept over both Sarah and Tom. They walked out, hand in hand, feeling a profound sense of achievement. They had navigated the complexities of 2025's mortgage market and emerged victorious. The first new mortgage statement arrived. Seeing the reduced payment amount brought a genuine smile to their faces. The planning and effort had paid off. They now had more disposable income each month, freeing up funds for other priorities. They started a dedicated savings account for home improvements. The stress of fluctuating interest rates was gone. The fixed payment meant they could budget with certainty, protecting their family from unexpected financial shocks. Their children would also benefit. Knowing their financial future was more secure allowed Sarah and Tom to invest more in their education and experiences. Friends often asked about their refinancing journey. Sarah and Tom eagerly shared their insights, emphasizing the importance of understanding fixed versus ARM. They stressed that what saves you isn't universal. It's deeply personal, tied to individual goals, risk tolerance, and projected time in the home. Tom often highlighted the need to look beyond the initial low rate of an ARM. Those future adjustments can be a real trap if you're not prepared, he'd warn. Sarah always added the value of professional advice. Mrs. Davis helped us cut through the jargon. It's worth investing in expert guidance, she'd say. They learned that a slightly higher fixed rate today might mean significant long-term savings and less stress compared to a gamble on future market trends. Their experience in 2025 became a testament to informed decision-making. They hadn't just refinanced their mortgage, they had refinanced their peace of mind. Years passed. Market rates fluctuated, just as predicted. But Sarah and Tom's mortgage payments remained steadfast, a solid anchor in their budget. Their initial savings from the lower fixed rate compounded over time. They were able to accelerate their debt repayment on other loans and build their emergency fund. They watched news reports about homeowners with ARMs facing payment shocks when their rates adjusted upwards. They felt profound gratitude for their choice. Their home, once a source of financial worry, was now truly their sanctuary. It was a place where memories were made, unburdened by mortgage anxieties. The lessons learned in 2025 stayed with them. They became advocates for financial literacy, encouraging others to educate themselves before making big decisions. Sarah often reflected on the initial confusion. It reinforced her belief that complex financial topics need clear, unbiased explanations. Tom, ever the pragmatist, developed a simple flowchart for friends considering refinance. It helped them navigate the options logically, based on their personal situation. They realized that saving money isn't just a number, it's the quality of life, the reduced stress, and the freedom to pursue other goals that matter most. Their decision in 2025 empowered them. They controlled their financial destiny, rather than being at the mercy of market whims or unexpected rate changes. The journey of refinancing taught them resilience and the importance of proactive financial planning. It was a turning point for their family's security. As their children grew, the consistent mortgage payments allowed for predictable long-term financial commitments, like funding their college education without strain. They even managed to pay down their mortgage faster than initially planned, making extra principal payments whenever possible thanks to their improved cash flow. This accelerated repayment meant they would own their home free and clear sooner, a major life milestone they now eagerly anticipated. The peace of mind they gained from their fixed-rate choice was priceless. No sleepless nights worrying about future interest rate hikes. Just steady progress. They often revisited Mrs. Davis's advice: "It's not about the lowest rate, but the right rate for you." This wisdom had profoundly shaped their financial future. Their journey from confusion to clarity, from worry to financial freedom, was a powerful story they shared with anyone contemplating refinancing their home. They learned that understanding the nuances of fixed versus ARM mortgages in the current economic climate was crucial, especially in a dynamic year like 2025. Their house wasn't just bricks and mortar, it was a symbol of their informed choices, their resilience, and their commitment to a secure future. Sarah and Tom's experience in 2025 served as a real-world example of how strategic financial decisions can ripple through decades, ensuring stability and growth. They felt immensely grateful for Mrs. Davis, for the clear guidance that empowered them to make the best choice for their family amidst the mortgage market complexities. Their story became a quiet inspiration for many. They demonstrated that with research, good advice, and clear goals, anyone could navigate their financial journey successfully. The impact of their 2025 refinance extended beyond their personal finances, influencing their overall well-being and their confidence in facing future challenges. They often revisited their initial worried expressions, comparing them to their present peace. It was a stark, reassuring contrast. Their advice to others was always simple: understand your personal risk tolerance. Don't let the allure of short-term savings overshadow long-term security. They emphasized that a fixed rate provides certainty. While an ARM might offer a lower initial payment, it carries the inherent risk of future increases. For them, in 2025, the fixed rate actually saved them, not just money, but invaluable peace of mind and predictable financial planning for years to come. Their story serves as a timeless reminder: making crucial financial decisions requires diligent research, expert consultation, and a clear understanding of personal priorities. As they looked towards the future, Sarah and Tom felt ready for whatever economic shifts might come. Their home loan was a fortress, not a vulnerability. The question of what rate actually saves you had been answered for them with clarity and lasting benefit. It was the rate that offered them the most unwavering stability. And so, Sarah and Tom lived confidently, their mortgage a testament to their smart choices in 2025, proving that true savings come from informed, strategic planning,